Trump and Powell have a gold problem, and not the kind that they'll put on record, but one that lingers behind every policy decision and political headline. Because each time the Federal Reserve announces its latest interest rate stance, and each time political pressure builds to steer those decisions, gold's value quietly does what no one can get the economy to do. It holds firm. Markets obsess over the Fed's language, and analysts are debating the implications of every basis point move. But gold's value proposition does not change with the press release, and that is the real issue. Because the more intervention monetary policy requires, the more obvious it becomes that the system it supports cannot function unaided. Gold, by contrast, functions just fine, leaving everyone to ask the question, will gold solve this problem? The Federal Reserve's decision just this week to maintain interest rates at current levels for a fifth consecutive meeting, while predictable, revealed fractures within the institution's consensus. Two members, Bowman and Waller, diverged from the majority by advocating a rate cut, an unusual development that drew significant market attention. Now, the result was a modest sell-off, with spot gold declining, and predictably, Chair Jerome Powell offered only vague guidance, underscoring the market's perpetual search for clarity in central bank signalling. This tendency to overinterpret the minutiae of Federal Reserve communication belies a broader, more structural reality. Gold's enduring value proposition is largely independent of short-term monetary maneuvers. And in what follows, we will examine why changes in benchmark interest rates have a limited bearing on long-term gold valuations, why institutional and central bank actors are increasing their allocations to physical bullion, and why the political climate surrounding monetary policy further reinforces gold's role as an asset beyond institutional interference. Conventional economic theory holds that rising interest rates, by increasing the yield available on alternative safe assets, suppress the appeal of non-yielding stores of value such as gold. Now, in practice, this logic plays out primarily in the short term. High-frequency trading systems and fund managers with quarterly benchmarks very often respond swiftly to rate expectations, leading to immediate but ephemeral price movements. The decline in gold prices following Powell's very recent remarks reflects not a fundamental reassessment of gold's long-term utility, but rather a temporary repricing in the face of ambiguous forward guidance. That markets continue to exhibit such sensitivity to minor rhetorical shifts from central bankers is a reflection of speculative positioning, not intrinsic value. Now, indeed, of course, a longer historical perspective undermines this assumption of a stable inverse relationship between interest rates and gold. During the 1970s, gold prices surged in tandem with rising rates, a period marked with inflationary pressures and geopolitical uncertainty. Now, conversely, the 1980s saw declining rates coincide with a prolonged bear market in gold. Now, empirical analysis over the past half century suggests a weak and statistically insignificant correlation between the two variables, approximately 28%, hardly compelling evidence for a causality. Now, physical gold occupies a distinctive role in portfolio construction. It is not held with the expectation of income generation, but rather for its function as a hedge against systemic and monetary instability. Now, this role is particularly evident among central banks, many of which have been increasing their gold reserves in recent years. Their motivations are rarely speculative, and rather they reflect a strategic recalibration of reserve assets in light of rising geopolitical fragmentation and concerns over the weaponization of fiat currencies. From the perspective of private investors, physical gold offers attributes that financial instruments just cannot. It carries no counterparty risk, is not reliant on the solvency of any institution, and is immune to dilution through monetary expansion. Now, in contrast to sovereign bonds, which may be subject to default, debasement, or capital controls, gold is a bearer asset that exists outside the purview of financial system. Now, this autonomy is more than a theoretical benefit. The existence of monetary policy committees underscores the fragility of the fiat system. These committees must continuously assess, calibrate, and intervene in order to maintain stability and the status quo. Gold requires no such intervention. Its value is not determined by quarterly GDP points or electoral cycles or policy areas. It is intrinsically self-referential. Now, recent developments in the political arena have raised really very valid concerns about the perceived independence of the Federal Reserve. Reports suggesting that President Trump inquired about the dismissal of Chairman Powell, though legally constrained, illustrate a growing tendency among political actors to exert influence over monetary policy. Now, while Powell has reaffirmed the importance of central bank autonomy, the distinction between norm and statute is material. Independence is not constitutionally enshrined. It is a convention. And as history has shown, conventions can erode under political pressure. The structure of the Federal Open Market Committee, long assumed to operate on technical merit, is now subject to internal dissent and political posturing. This not only undermines the credibility of monetary policy, but it also raises questions about the long-term reliability of fiat governance. And in such an environment, assets that exist outside of political reach, such as physical gold, naturally assume greater significance. The fiscal context within which the Federal Reserve operates is itself deteriorating. The national debt exceeds $36 trillion, and economic growth has moderated significantly, averaging just 1.2% in the first half of this year. And despite this, Congress continues to pass expansive spending measures without meaningful fiscal offset, placing additional pressure on monetary authorities to accommodate that deficit. This creates a precarious policy dilemma. On the one hand, maintaining elevated interest rates to control inflation could exacerbate debt servicing costs, but on the other, reducing rates risks fueling further inflationary pressure. The temptation to monetize debt through implicit financial repression by keeping real interest rates negative is growing. And markets appear to recognise this bind. While the probability of a September rate cut has declined to 44%, the broader trajectory suggests that policymakers will be compelled to ease eventually. Now, in this environment, clarity is elusive, and the rationale for holding gold, an asset unencumbered by such promises, strengthens. Now, Chair Powell's commentary this week offered little in terms of concrete forward guidance. He reiterated standard talking points: economic resilience, anchored inflation expectations, data dependency, without committing to a discernible path. Yet market participants parsed his language for implicit clues, with some concluding the easing remains plausible later in the year. This reliance on rhetorical interpretation very much reflects the limitations of modern central banking. When policy is driven more by expectations than action, the entire framework becomes an exercise in signaling. The reduction in gold prices, therefore, was not the result in a change in fundamentals, but the temporary disappointment of investor sentiment. Meanwhile, consumers are contending with the tangible effects of inflation, trade policy, and rising costs. Central banks can influence the cost of money, but they cannot resolve supply-side shocks or legislate against global dislocation. In such circumstances, gold's appeal as a non-manipulable store of value becomes more apparent. At the heart of the matter lies a question of trust. The modern financial system is predicated on confidence in institutions, in governance, and in the rule of law. When those foundations are perceived to be weakening, the appeal of sovereign, independent assets increases. Physical gold, unlike paper claims or financial derivatives, does not rely on anyone's promise. It does not require a functioning bond market, a cooperative legislator, or a compliant central bank. Its existence and value are not contingent. They are absolute. And this is why physical gold remains relevant, not as an instrument of speculation, but as a long duration hedge against systemic uncertainty. It offers a measure of sovereignty to the individual and the institution alike, at a time when political and monetary systems appear increasingly entangled and unstable. In conclusion, while interest rate decisions continue to generate short-term market fluctuations, their broader significance may well be overstated. Rather than interpreting every Federal Reserve announcement as a referendum on gold, investors would do very well to consider the structural context in which these decisions are made. A politicized central bank, a ballooning deficit, and a volatile geopolitical landscape all conspire to undermine confidence in fiat regimes. And gold, by contrast, that offers stability without that dependency. It is indifferent to election cycles, budget battles, and policy missteps. Those who hold physical gold are not reacting to headlines. They are responding to human misstep and lessons from history. Gold, they've realized and learned, avoids the problems brought on by the fiat and political system. And in doing so, they are asserting a form of financial independence that in this climate is both rare and prudent. Now, coming soon, we have a new guide that will explain the 5 crucial steps to navigate gold investment. So if you click on that link below, make sure that you're the first to receive your copy. Those first to sign up will be invited to an exclusive webinar with the Gold Core team. We'll see you there.